Welcome friends. Today we will discuss about capital account convertibility. Up to now we have seen ADRs and arbitrage. So today topic is capital account convertibility. So what is capital account convertibility? As RBI has defined and also Tarapur Committee of 2006 has defined it. The freedom to convert local financial assets into foreign financial assets and vice versa at market determined rates of exchange without any sort of intermediation and regulation. So there are three components for a capital account convertibility. First component is freedom to convert both sides from local to international or from foreign financial instrument to local instrument. One thing. Second thing is at the rate of market determined price. There should not be any intervention even in market determine the rates or exchange rate. Third is, of course, there should not be any regulatory framework or intermediation or any restrictions. If three component fulfilled, then only it is a capital account convertible currency we can say. Now question coming, why it is capital account, why not current account? So there is a difference. We should understand. Capital accounts refers to expenditures and investments in hard assets, physical premises or factories, as well as investments in land and other capital intensive items. So you can see here all physical assets, long term assets are under capital account. That is why it is called capital account convertibility when this convertibility is allowed. Current accounts comes under short-term investments or short-term any exchanges happening, and normally it refers up to 1 year. So this is the difference. That is why it is not known as current account convertibility. It is known as capital account convertibility. Another thing is India is a partially capital account convertibility country. India does not allow full convertibility so far. Why? Because if we have full convertibility, then there are certain issues, especially one can see the example of Thailand or Asian crisis of 1997. In July 1997, it so happened all West investors they simply started to fly, and due to this big crisis occurred in Thailand and other countries, it expanded, and Russia also default happened due to this convertibility in 1998. So there is issue with the full account convertibility. Any country can have convertibility, but for that, economy should be extremely stable, one thing. And second thing, citizens never feel insecure, like in Thai baht currency. Due to insecurity, a lot of people simply fled. Another thing is There should be moderate and steady inflation. If inflation is range bound within a short, then it is okay. If cannot be controlled inflation so strictly accurately, then there is problem. And fiscal deficit to GDP ratio must be kept at low. So if these things are possible, fully under control, then any country should think of going full capital account convertibility. Of course, IMF and World Bank imposes this clause, try to impose this clause. Whosoever goes to take loan from IMF and World Bank, they want foreign investors have the exit option quickly and hassle free, especially during economic crisis or something happens, so that they can easily and quickly liquidate their assets and run away. So this is the pros and cons with the full account convertibility. Up to now, India didn't give any full account convertibility. Partial convertibility allows FIIs, foreign investors, to invest in Indian stock markets. They can take their profits and along with their capital or this investment amount. That is why so many of FIIs don't invest in here physical offices or whatsoever coming under this capital account category. That is why they avoid this one. But the same time, India has protection so that they cannot run away with their money, and India was left lurching. Even now, we can see with partial convertibility, FIIs, whenever see their investment can grow as per their convenience, they comes and slight feel of anything wrong or any trouble, they simply run away. Even now we can see there is no such thing, but lots of FIIs for so many months simply withdrawing money from Indian market and going to China market. So it is possibility. Another thing, if India have full account convertibility, we can see this 2020, this Galwan episode. And of course, the surgical strike or with Pakistan. At that time, people may feel insecure here. Maybe India will go war with this, and they start to fly from here. This this will lead to serious crisis without any reason. Of course, this all has been managed, but if capital account started to flee in crisis in a very short period, then it will be an extra thing to manage and very difficult to manage. So it is, in my view, good step by Indian government to have partial account, capital account convertibility. Hope you would have got understand what is partial or full capital account convertibility, current account, why it is known as capital account convertibility, all this. If you find some value in this discourse, please like and subscribe to this channel. Please also share with your colleagues and friends so that they can also get some value from this conversation, this video. Thank you. Bye bye.